Absolutely. And maybe to go just one step into the more technical thing, just bringing up some Cisco earnings, which I thought was real interesting. You had seen some real unusual volume on Cisco options right before a Cisco earnings announcement, and then on the next Cisco announcement 3 months later, you saw unusual volume on those options before. Now, on one of them, the first one, the Cisco stock went up after they announced. The second one, they went down after they announced. And what I think is interesting is, there's a lot of rumors that fly around on a big company like Cisco, which traditionally likes to beat earnings by a penny.
Right.
But what it comes down to is what John Chambers, the CEO, says as they are announcing earnings. If he sees
what's the guidance?
What's the guidance?
Exactly.
If he sees smoother sailing, the stock goes up. On the second announcement, they still beat by a penny, but he cautioned a little bit, so the stock went down. But in both situations, the unusual option activity tipped you off to not what the earnings were going to be, but what the comments of the CEO is going to be. I mean, how many people know that other than the CEO himself and probably just a handful of key people around him? Of course, it maybe filters out and tells people. But what I want to get to is you saw call option activity on both of those. But if you were just the lay investor, you could be looking at Cisco call options the day before they announce earnings and see maybe some real unusual volume. But how do you know that it's someone? Yeah, right. Because as people may or may not know, with options, they get really tricky. A call option volume isn't necessarily a bullish thing. And so how do you tell if it's because someone might be buying or selling, and that volume is either buying or selling volume. So you want to just
Sure.
Yeah.
For instance, folks, let's say that we're talking about Cisco. In the case of what happened in Cisco on the first earnings announcement that Preston talked about, those were actually people in there aggressively selling put options. Cisco was trading, I think, right around $23, 22 3/4, something like that. The 22.5 puts were extremely active. Towards 90,000 of these had been sold, not bought, sold. If you were just paying attention to puts, you'd say, boy, very unusual put activity. That must mean bearish activities happening in Cisco. You would have been wrong. They were selling those puts. They were hitting the bid because there's a bid and an offer for every option. They were hitting on the bid side, meaning that somebody's bullish, because if you're selling that put, you're taking on the obligation that you would have to buy Cisco if it fell. And it fell below $22.50 a share, you'd have to be a buyer if you sold those puts. That's the obligation you take on. For taking on that obligation, you collect a little premium. Well, these guys were selling 60,000, 90,000 of these Cisco puts. They were going to make a couple $1 million if they were right, and if they were wrong and Cisco's earnings were bad and Cisco fell, they could lose 5 or 10 times that amount. Well, the informed activity, we reacted to it, told everybody it was positive. Cisco must be coming out with positive earnings based on these people selling these puts. Indeed, Cisco came out, met street estimates, guided a little bit higher, stock traded up. Those puts finished worthless. Next earnings cycle, the stock was trading at right around the same levels, and they came in to sell the calls. Now, obviously, again, you see unusual call activity, you might think that's bullish. If it's occurring on the bid side, it's not bullish, it's bearish. Because if I need to sell, if I'm a big institution, folks, and I need to sell a whole bunch of calls, I'm going to be selling them through the bid. In other words, the bid might be 50 cents bid offered at 55 cents. And if I need to sell 20,000 of them, I'm probably selling them down to 40 cents or so, Preston. I'm not getting them all off at 50 cents, and I'm certainly not selling them on the offer at 55. Because everybody's sitting there saying, why should I buy them? There's 50,000 offered there. So instead they come in and smack the 50 bid, smack the 45 bid, smack the 40 bid. They're selling all those calls. It's unusual activity, but it's not bullish activity. And indeed, Cisco came out, met street estimates, didn't have any positive guidance, and the stock traded down. Those calls finished worthless as well.
Which is great. You sell them, collect in the premium, and then that's what they're anticipating
as
a stock to go.
And that's what the smart money was doing. Go with the smart money.
The unusual volume that you see, and on the side of the market that you see it on the bid and ask, the inside options members, they don't have to worry about that, about all that tricky stuff. That's what you are scouting out first before you send out an update to them. So
Exactly.
you've already looked at that, and they don't have to worry about that.
Right. We're putting it out, Preston, that it's trading on the bid and it's a bullish sign, or it's trading on the offer and it's a bullish sign. We're telling them for them so that they know. In other words, if people are selling puts and it's bullish, we're going to tell them this is a bullish trade that's going on, and here's why. And if it's somebody selling on the bid in the calls, even though it's unusual call activity, that's not bullish. If they're selling on the bid, that's a bearish sign. We're going to tell them it's bearish.
Okay, so now it's clear to me how I would play an unusual volume update. And just to clear this up, in case someone's wondering how they should trade along with this, because it's just obvious to me how it jumps out is if the smart money's buying the October 40 call, I'm going to buy some of those too. So is that as easy as it is? If you're seeing the unusual volume on a particular option, should they just go with that same option?
They probably should go with that same option, Preston, or turn it into a spread. Okay. And that's part of the new thing that we're going to be offering with the premium service is turning that into a spread that they can make money from. For instance, given your example, let's say we see unusual activity in the 40 call. It could be that maybe we can put together a spread where people can buy the 37.5 call and even sell the 40 call. The guys that are buying the 40 calls, we're still hoping they're right. That 37.5 40 spread is going to expand. If those guys are right, it's going to move out to that full $2.50, and we might be able to get them in for cheaper with less risk by putting them into a spread, Preston, where they have more time to be right too. Because that's the only dangerous thing when they're playing the unusual activity game, especially if they're short-term options. Like I say, I believe it's somewhere between 70 and 80%. Bam, bam, bam. You know, these things are happening. Something's about to occur. But for that 30% of the time when it's not working out, when somebody bought a bunch and their intel was not as good as it should have been as far as gathering the information about positive earnings announcement, new product announcement, or whatever it might be, cover of Barron's, those types of things. If it ends up not being what they need.
Yeah, because there might be a terror attack or Greenspan might come out of the blue and just say something weird. Or
there could be a host of things that could cause just the best laid plans of mice and men to not go the direction that these guys thought they should go. And for those times, I think having a bull call spread or something like that is how people are going to make more money with service.
Okay, and I just see some of the biggest scores. I mean, when you do buy the options and don't have the spread, because of course the spread limits your potential profit to the difference between what your spread is. But if you just have this, you know, the one option which can run unlimited.
For the home run hitters, you want to just have the one option.
I guess it depends on someone's risk tolerance. I mean,
exactly, and how actively they're managing their positions.
That's true.
I mean, if they've got a pager on their hip and they're saying, boy, I want to be along these for $1, and I want them to go to 10. We all want the option to go to 10 that we buy at $1, but on the way to a $10 run, maybe it's trading $1.50, maybe it's $2, $3, $4. At what point do you pull the trigger? Right. So if you're somebody that, like I say, has a pager on your hip or a broker that you've given some discretion to, then you could swing for the fences like that.
All right, that makes a lot of sense. And before I move on to the trade of the day, I just talking about this this interesting thing that you see that we really couldn't see at home. There was an eBay earnings not too long ago where I remember I was on the phone with you. We were doing a radio show or some kind of a thing. I believe it was on a Wednesday. They were going to announce after the close. And I remember at first you guys were looking at the option volume and saw calls, but then you saw a lot of put volume. But then when you did the time and sales, which basically the time and sales is you take a look at a specific trade, like a big block trade, and you can see at the minute it was traded if that was on the bid price or the ask price. That's kind of your secret, isn't it?
Right.
You see it on your computer.
Exactly.
And you were noticing the put volume. This wasn't just people thinking it could go either way. The put volume was on the bid, which was selling put volume, which is bullish, and the call volume was on the offer, which is bullish. Yep. So they were lining up on both sides of it. Of course, eBay had a $9 spike the next day after earnings.
After a great earnings.
My favorite plays, John.
Yeah, well, I love them too. I mean, and if somebody's willing to take on the responsibility, the ownership of the stock by selling a put option, they're telling you a lot about how bullish they are about that stock. Number one, they're collecting a premium, which they stand to make money from, of course, if the stock stays above the level of the strike price that they've sold, but they're also telling you, I'm willing to buy this stock if it dips. They're not expecting that to happen, especially when they're selling these in big size. So you're absolutely right, Preston. Unusual call activity and unusual put activity, and they were about balanced, but the calls were happening on the offer, that's bullish, and the puts were hitting on the bid, that's bullish too, and the stock took off the next day.